Okay, terrific. Well, welcome everybody. Welcome to our quarterly market update, our first virtual market update here at Spinnaker Investment Group. So thank you so much for taking the time to join us. My name is Joe Stapleton, and it's my pleasure to be here with you this afternoon. I'm the president and co-founder here at Spinnaker Investment Group. We appreciate all of you taking the time to be here. We know there's a lot going on, and this has become part of an ongoing series here at Spinnaker Investment Group. We're going to do this following each quarter. We're in a meaningful dialogue about what's going on in the investment markets. And we're so excited to have over 100 people joining us this afternoon. So we're really looking forward to this. Some things that separate us from our competitors out there and from other wealth management firms is really the fact that we're so focused on education and really being a resource for our clients. We do believe that knowledge is power. And we think that really does set us apart when we're really talking about communicating philosophy with our clients. And today, this afternoon is going to give us a chance to do that. So by educating clients, we feel like we make informed investors. And there's certainly a lot going on right now in the news. There's a lot of noise out there, and certainly during this pandemic. So we want to spend this time to answer any questions you might have, go through things. This is some things that a lot of us haven't seen in our lives. And here at Spinnaker Investment Group, we're just over 4 years old, managing $350 million in assets now. And we really wanted to spend the time as a wealth management firm really improving that overall client experience. So we're excited to be investing in technology and certainly bringing you things like we are today. So with that, I'm going to talk about the format for this afternoon. And really, ultimately, this is an opportunity for you to ask the wizard, Morgan Kristen, what's going on in the marketplace. So today, we're going to be doing a quarterly review. We're going to talk a lot about U.S. stocks, foreign stocks, and bonds as well, economic trends, market conditions, and opportunities that we see that are out there. So there's a question and answer feature on the bottom of your Zoom screen there. So if you want to click that, and then put in any questions you have, I will be more than happy to interrupt Morgan and ask him questions as they come in, and we can also save those for the end. So if you have any questions, use the question and answer feature at the bottom of your screen, and we'll get those at the end. So with that, I want to introduce one of our fellow partners here, Andrew Krongold. Thank you, Andrew, for being here. You guys are going to hear from him momentarily after Morgan's presentation as well. So with that, let's go without further ado. Morgan Kristen, Chief Investment Officer, and my partner here at Spinnaker Investment Group, affectionately called the Wizard. There is nobody smarter in this business, nobody we'd rather be doing business with, and nobody protecting your assets better than Morgan. Morgan is a CFA, a CFP, and been doing this for over 27 years. So with that, Morgan, the floor is yours.
Great. Thank you, Joe. Well, we're going to take a little ride today. We're going to talk about last quarter, the second quarter. We're going to talk about how that moved from the first quarter, bit about the economy, talk a bit about some threats and opportunities we see out there. You know, every quarter and every month we put a newsletter together, but on a quarter we do a little bit more information, and this will kind of get into some of our methodology, some of our research that we look at when we make moves in our portfolios. So keep your hands and arms inside the car at all times. Don't stand up, and let's enjoy this ride. First up, looking at markets last quarter, what a comeback, right? So we look at the S&P 500, 20% up, all the way down the line. Everything was up. Still year to date, some of these sectors like S&P. Now, again, this is through June 30th. S&P down, small company stocks down, international and emerging down. But look at bonds here. Interest rates, which we'll talk about later, interest rates continue to go down, which has certainly helped bond buyers because the values have moved up. But you still look over at stocks, and as bad as the second quarter was, a 10-year holder of the S&P did well, so did 5 years. So overall, stocks look pretty good, and second quarter certainly saved the year so far. So let's look at 1 year back. Let's go back to June 30th of 2019. And so what did we see out there? Well, leading up into the end of 2019, we had the Dow dropped about 800 points, and then the Fed started cutting rates there. Remember, before that, they were actually boosting rates up. Manufacturing had sputtered a bit. And so there were things that were actually slowing down the economy before this hit. But as we ended the year of 2019, stocks had a decade gain of about 190%. So a nice end. And then we went into the year, that's when the coronavirus was found, but we kind of blew it off a bit. The Dow closed at record highs as worries abated. Now, let's look at last quarter that ended in June. So there was a fourth of the economy that was totally idle because of the lockdown. China's GDP fell. The virus shrunk the economy. A decade of job gains was erased in April. Industrial production fell, and the Dow right here, this is as we kind of go into this towards the end of the second quarter, the S&P 500 was up 40% in 50 trading days. So a heck of a move from the lows back in March. And then at the end, you had stress tests. The Fed did a stress test on the banks, and they said that they'll be okay to withstand Corona. And then we closed out the quarter with the best quarter since 1998. So that was, again, second quarter. So looking at all the different world asset classes, it looks like, you know, risk was the word of the day or word of the quarter, actually. So we had March, again, it held the record for the fastest bear market, which is a 20% decline. In only 16 days, the S&P fell to a bear market. But as we went into the second quarter, the risk was on. There was purchasing of emerging markets, Russell 2000. Those are small company stocks. Then you had the S&P down here, but really growth stocks, small company stocks, riskier stocks had a heck of a quarter. And just to put some perspective in there as far as, you know, going into the fastest bear market in 16 days in the first quarter, usually bear markets going down 20%, the index usually takes about 255 days on average. So it was a heck of a move down in the first quarter. So I would say we're probably not completely surprised of the market moving up in the second quarter. Now let's look at first U.S. stocks and what did well in U.S. stocks. Well, small growth stocks did quite well. So where was that? Well, there's some technology in there. There was some biotech, Novavax, Inovio, or some is a small cap growth company. But you'll see growth in both the large and the small. A lot of that was technology. Large technology stocks actually did quite well. And so just to give you a look at what a small cap is, those are capitalization, small capitalization, share price times shares outstanding. So small caps are about 300 million to 2 billion, with mid being into 2 billion to 10, and large companies being over 10 billion. But you look down here too, and you'll see that year to date, large growth, a lot of it fueled by technology, up for the year, but on down. Just large cap in general, small market wide, all still down. Small value has really been hurt. That's industrials. Some of the banks are still off for the year, the 1 year, 3 year, and then of course 10 year. Now looking at next the international markets, kind of the same story. So small cap growth at the top here, and just growth in general. And then you'll notice here we also show what it looks like when you take into account currency. So in the local currency, small company stocks at about 18.73, but then you repatriate back into dollars. U.S. investors did a little bit better at 21.66. Looking at international though, not really a great, you know, maybe 10 years, but not so great 5 years. So year to date, 1 year, 3 year, not too spectacular when you look at international stocks. Moving forward with emerging markets, some of the same story. Again, small companies as well as growth companies. And I think that's also the tale of technology, but also looking over time, you know, one starts to wonder why they own emerging markets when you look at some of these numbers, or one looks at it and says maybe things will be better in the future. We don't know, but certainly not a great 10 years for the emerging markets. Now, looking at different markets. So the reason why we show this is why maybe you don't want to be in emerging markets, but maybe international markets make sense. So looking at developed markets in the second quarter, Australia was at the top. Here is the US here. So Australia did significantly better than the US market. Now, part of that was currency, but you can see where some other, we're not always the top country. In fact, many years we're not. So international markets do have some good performance. Moving forward here to real estate investment trust, so REITs. REITs generally do well in a low interest rate environment, and we're certainly there. But you had investors concerned with retail, malls, office. I mean, we're doing Zoom like we're doing today. People aren't going to their offices. They're definitely not going to malls. They're not shopping. We don't need to go get a suit anymore. You don't need a dress. So malls certainly got beat up. Real estate was beat up. So year to date, real estate investment trusts still off the 1 year, 3 year, and 5 year. And that's both here domestically as well as the international markets. Commodities, obviously some specific commodities have done well. I think silver hit a higher number today. Gold has done well finally after many years of not. But you look over time, so this is a basket of the Bloomberg Commodity Total Return Index, and it's not too promising. The part over here to the right, this is just the second quarter, and after a very abysmal first quarter in oil and gas, they really made it quite a comeback. But you look over time, quarter was good for commodities, but year to date still down 1 year, 3 and 5 and 10 year. So if you were in this for 10 years, you would have lost about 6% per annum. Fixed income, so bonds. Here we were a year ago, June 30th, 2019. So still a pretty flat yield curve, a little bit higher in the short term. And as we go up to 30 year, pretty flat, kind of an indifference curve. Why would I go out 30 when I could get pretty much a close rate here? However, we're at least at 2%. You look here, really we're unchanged from the first quarter. Here's our yield curve as we stand today. We're almost at 0 here on the short term, and we're barely clipping over the 1% level. In fact, as of last week, the 30-year, I didn't check it today, but a 30-year bond sat at about, I think 1.3%. So pretty low rate there. Now, we look much like the United Kingdom as far as they do have some negative yields here. Germany definitely has negative yields. In fact, they're almost out to their 20 years sitting with negative yields. So Japan looks much like ours. So rates are extremely low, but ours, I guess, look attractive compared to, say, Germany. We showed earlier how bonds actually have done really well over I think the 1, the 3, and the 5 year. And it's kind of understood because as interest rates go down, it's that teeter-totter. Interest rates go down, bond prices go up, and we're starting to hit that bottom there. I mean, it's when you start hitting 0, we're pretty darn near the bottom. We certainly could go negative. We hope we don't, but appreciation for bonds have really kind of ran their course. Now, let's shift gears here. Let's talk about the economy. So this is a thing I talked about a while back in one of our newsletters. So in Oregon, they have a very large, it's the largest underground mushroom. It's called the honey mushroom. And this mushroom is so large, about 3.5 square miles, and it really can suck the life out of a bunch of different trees. So we're going to talk about some areas that could suck the life out of this market. I think it was really interesting, this quote. I think it is really a good quote by JP Morgan CEO Jamie Dimon. And what he said is, it's really not a normal recession. Really, the recessionary part of this recession, we haven't even felt yet. So we're going to feel some of that down the line. So let's explore some of those areas. Well, we have initial jobless claims. They're getting a little bit better, right? We're seeing some things that are improving a bit. You see here, obviously, a huge spike. It's come down a bit. We're shutting down in California and some in Texas, so we'll see if that changes there. Historically, there's not really a consistent relationship, though, between changes in jobs and changes in the stock market. And we're not implying that Wall Street doesn't care about Main Street, but it just usually the market leads the trend in jobs. So, there's going to be business failures. There'll be job losses. A lot of those are not going to be temporary. There's stimulus there, and it's there to support the economy when it reopens, but it's not a life preserver. So this stimulus was massive. It's many times the size that it was in 08 through 09. So it should support business and labor. Now, looking at restaurants and retail, they've been hit the hardest. This is a Yelp report. And so you can see, and this was, I ran this, gosh, yeah, here we go. As of June, total goes out of June 15th, but I looked at it again and things hadn't been, they were improving a bit, but you know, in California and a few other areas we shut down again. But looking in their review over about 28,000 shopping and retail companies, about 35% are going to be closed permanently, with 65 temporarily. Restaurants obviously fared worse, about half and half, and then beauty and fitness. So just to look at the size of this pandemic and the local impact, you look at in Miami, Hurricane Irma. So coronavirus is about 4 Irmas. In New Orleans, it was about 4 Isaacs. In Houston, about 4 Harveys, about 8 Sandys, 13 blizzards from New York, and about 16 Chicago cold waves. So pretty intense. Also, we have quite a few bankruptcies, right? So we've heard about some of these here. True Religion, Pier 1. Also, for any of you with young children or having children, I do have to say Chuck E. Cheese is also gone. I'm sorry that you won't be able to experience that big dirty rat walking around. So sorry that you won't be able to experience that. But then we had Hertz, which we wrote about last quarter, Vantage Rent-A-Car, 24-Hour Fitness, and Gold's Gym. And the interesting thing about the gyms is that they were actually absorbing a lot of the space from supermarkets and big box stores that went out of business. So it'll be interesting to see what happens with some of the commercial real estate as those buyers or renters in the gym space kind of work through their bankruptcies. Airlines, this is the TSA screenings, looking at passenger traffic, and obviously it's fallen off a cliff there. So I don't anticipate this will pick up anytime soon. So obviously this impacts airlines and big industrial companies, hotels. So these numbers have ticked up a tad, but nowhere near where they were in the past. So not a great sight for that as far as airlines. Missed payments, so Apartment List did a review and they did a poll asking if they paid their rent or mortgage. So really their numbers spiked in May and it tapered off a bit in June. What they found though is those that didn't make those that struggled in May probably were having problems in their June. In fact, those who didn't make the May, that 13%, 52% did not make a June payment. So, you know, this limited job recovery really raises some key questions. You know, how will these folks be able to pay rent once that $600 weekly unemployment benefit ends June 31st? And we'll talk about that a bit more. But also, banks are really looking at this too. JP Morgan, Wells Fargo, Citigroup, they set aside about $30 billion in the second quarter to cover some of these potentially bad loans. So they are certainly ramping up. But if you look, single family residents are really not a major problem yet. It's generally retail and lodging. So, you know, we're seeing some of the red, that's where it's going back to the bank, but late and going back to the bank, increasing in retail and in lodging. So that's certainly has implications for the commercial real estate markets. So impacted sectors and I guess stocks and, you know, obviously apparel. We're not going out as much, so no need for apparel. Malls aren't open. And then gaming, you know, some areas have opened, but some people aren't comfortable. Lodging, leisure, restaurants, and of course, airlines with travel, sports. The University of Michigan, actually with sports and the kids on campus, they're forecasting that they're going to lose about $1 billion this year. So that's a huge number. So sports not only hurting schools, but cities. And look at here in LA, we have the Rams and the Chargers with a new stadium that no one can go to, and certainly hurting landlords. But if we could talk about a few good things, so what's good and what's happening these days? Well, for some reason, this, like I said earlier, this is an odd recession. We are all going out and getting the family truckster. The sales of RVs have gone through the roof, as have boats. Try to book someone to do some work in your backyard. We're all getting pools these days. So it's really a strange recession. And that's why I think Jamie Dimon said we haven't found the recessionary part of this recession yet, because people are spending in certain areas. And there's also looking at some good areas. Housing's holding up. There's still a lack of inventory. We are starting to see housing units increasing here when we look at housing starts. Trucks, light vehicles, and maybe this is the folks that maybe they bought a fifth wheel and they need to tow it. I don't know, but we're seeing a little pickup in autos. We're seeing a little bit, and this was before the shutdowns in Texas and California, but retail sales, and certainly it's probably more food. Food sales have gone up a bit, so we're seeing a little bit of an uptick there. Now, if we look at threats to the market, obviously we have an election coming up, right? So we're not going to get into politics here, but this is where all these different presidents, where the markets have gone, some up, some down. Some Democrats have won, some have lost as far as the market. Some Republicans, it's been up, some have been down. But really, when you look at, you know, if you want to sit there and wait for your team to win, you can see here, if you wanted to wait for the Republicans or your Democrat, whoever's team you're on, you didn't fare well. Of course, this is back to 1896. You know, staying fully invested made sense. However, a divided government generally is better for the market. And so we'll see how things go going forward. A unified government generally is not great for the stock market. Another risk is there is heavy concentration. You know, this so-called market, the S&P 500, 27% of it is in technology. So it's really been driving that. And to drill down a bit more, the top 10 constituents of the S&P 500 are right here, of which about the top, you know, it's really 6 companies, but Microsoft, Apple, Amazon, Facebook, and Google, that's their return so far year to date. So big part of the market is being driven by these technology companies. In fact, when you look at all the 500, and I think it's 504 constituents, about 400 are still down, and some sizably. So that could also be seen as a positive too, because the whole, you know, market has not come back. There's also the rise of the day trader, the gambler. So we have Robinhood now, which is a hot app. Talked about it a bit in our last newsletter. So basically, it's very easy to use. You can use margin. You can buy options. You can see here that the velocity of their options in blue here is a lot stronger than TD, E-Trade, or Charles Schwab. They also looked and they realized or they did research and saw that a lot of the Robinhood app participants also had DraftKings accounts. So DraftKings is a sports betting site. So with no sports, our sports bettors have moved over to stock betting. So we'll see how that goes. It's really, I don't think it hurts the overall market, but it certainly has pushed up certain companies like Chesapeake Energy, Hertz, JCPenney, 3 companies that are going bankrupt, but however, you know, have moved up substantially, which was odd. You know, companies that are, you know, just they're, Hertz probably won't make it. They have 19 billion in debt, but you know the stock went up, so it's back down. But the rise of the day trader is certainly interesting. It's adding volatility to the market at the least. Speaking of volatility, you know, there's always going to be volatility in this market, and in fact, 2018, you know, that was a year when the market was actually down, but you know, when you look at intra-year declines, it was down over 20%. So we'll probably have some volatility going forward. It's pretty common. There are years when you have big volatility and the market ended up being up, but you know, looking at market drops and losses there, you really technically don't lose until you sell, but volatility will be here in the future. Now, this is a risk to the market also. So I talked a bit about that $600 a week. So when you look at that ends this end of this month on the 31st. But you look at this chart here in red, this is the high income earner. So that consumer has really dropped. They're not spending, they're off about 11%, whereas the lower income consumer really hasn't changed. So when you look at where GDP comes from, you know, a good part, the top quintile of income earners are about 61% of spending, and they're about 42% of GDP. So when they're not spending, that certainly hurts the economy, and they haven't spent here. And you look at JP Morgan saw that the aggregate spending of the employed was people that are employed was down 10%. They actually saw that the spending of the unemployed, those that receive that $600 benefit, was up actually 10%. So that'll be interesting. That's certainly a risk in the market. So what are the opportunities? Well, you know, every generation had a share of challenges. We had Black Tuesday, we had wars, we had presidents being shot, presidents resigning, market crash, 9/11, and of course our last recession. But so we've seen things before, but also you look and there's a tremendous amount of cash sitting on the sidelines. You know, our business, the investment business, is a really interesting business. When things go on sale, when the market goes down, people run away from it. Nordstrom, any other place goes on sale, people flock to it. But you can see the massive spike in short-term bonds and money market funds over the last year. So there's a tremendous amount of cash on the sidelines. I don't know what it takes to entice people over, but there's certainly some of that dry powder. But it's raining cash. So Mitch McConnell and Steve Mnuchin, they're right now, I mean, everyone's working on a plan. So these new COVID cases, they're stalling the economy. Funding for schools, possibly a check for individuals and families, possibly that 600 again. There's certainly a fight over that. Some incentives to get back to work. Yes, the deficits are growing, could surpass $4 trillion this year. Trump and Powell want a bill, as do most Republicans and Democrats. Trump wants a payroll tax cut. McConnell wants liability reform. The Democrats want aid for state and local government. Everyone is looking at some school aid, but something will be done before the August break in probably the $1 to $2 trillion range. But we're going to have a couple weeks of bickering before this bill is enacted. So I don't think this will necessarily make the market rebound, make it a V shape, but it'll certainly prevent the economy from tanking. Looking at the challenges of having cash. So sitting in a CD, adjusting it for inflation, although it is safe, your money will not go to zero. You are losing money over the long term. Inflation is certainly there. It is certainly eroding the value. But also when you start looking at longer term bonds, anytime interest rates move, because interest rates are so low, again, back to that teeter-totter. Now we'll go the other way. Rates up, bond values down. 2% increase in interest rates, you could lose about 10% overnight. So be careful with your bonds. There can be, if they're longer term, longer duration bonds, some risk there. And you look at the yield on the treasury yield, they've fallen close to record lows. And then you look at inflation expectations, which actually have increased a little bit. You know, they've created a negative yield, negative real yield, I should say. So taking that yield, subtracting out inflation, and you're actually negative. So you take those two together and you can really explain some of the strong performance in stocks recently, at least, as people were pushing towards riskier assets. So other opportunities out there is fourth industrial revolution. It's been going on for a while, right? So we went from steam to electricity and computing, and now how do we connect that all together? It's really kind of everything coming together. We're blurring the lines between physical, digital, and biological. So obviously we hear a lot about AI. We're starting to, the computer's thinking like humans, the blockchain. I'm not talking as much about Bitcoin here, but taking a decentralized, transparent way of sharing data, no third-party intermediaries, virtual reality, biotechnology, harnessing cellular and biomolecular processes. So a lot going in there in pharmaceuticals, materials, robotics. So for individuals and other use, commercial use, 3D printing. So if you run a company, you can have less tooling, bring it at a lower cost and faster. Some innovative materials, Internet of Things, things that you wear, but things in your house, your refrigerator, energy capture, a lot of things changing there as this merging in this fourth industrial revolution. So the technical part of it, internet software, autonomous driving, on the gene side, gene therapy, editing, diabetes monitoring, consumers, so obviously social networks, but remote learning, which is huge now, as at least here in California, most counties are now going to go virtual for K through 12, so remote learning, hopefully we enhance that. These are not recommendations, but here's some companies that are doing some innovative things in, say, technology. Twilio, that's your connection when you go on Uber, NVIDIA, and cars and gaming. Like I said, Internet of Things like Ring Central, and like we're doing right now, Zoom. If you've done a mortgage lately, DocuSign, although I don't believe California, I think we're the last state to allow DocuSign of those kind of documents. Consumer discretionary, Lululemon, the athleisure, Peloton, obviously you can work out at home with Peloton, and Lululemon just actually bought Mirror, which is that mirror you stare at to do a bunch of different exercises. So some innovation there. Healthcare, I said earlier, glucose, mobile glucose monitoring. That's a company like Dexcom. They do that. GW Pharmaceuticals, working with cannabis. They're working on childhood epilepsy. So some innovation there, and certainly the healthcare and tech, biotech area. So what does this all mean? Well, I think I showed earlier, there's some economic reports that are supporting valuations, but there's obviously some risk. These lockdowns, if they continue, it will continue to slow the economy. I mean, it is slow already. That second wave, or actually our ramping of this first, U.S.-China trade war, any ongoing civil unrest, that's going to start weighing on consumer confidence. Then we go into hurricane season, pandemic. It has a grip on the economy. It probably won't loosen until there is a widely available vaccine. But interesting there, I mean, the good news though, back to that biotech and all of that, in 6 months since the outbreak, there's about 140 vaccine candidates that are in preclinical trial. 23 have entered the clinical evaluation, so that's exciting. But the economy probably won't loosen up until there is some kind of widely available vaccine. These reversals, so we were open in California, now we're not. So they're certainly very tough on the consumer confidence, and we still believe there's more of a swoosh, the Nike swoosh recovery. We don't see a V. As things come back online, as vaccines come out, things could get better. But rates are going to remain low for a while. The Fed is going to remain accommodative. They have stated that. So that's good for stocks. If you're someone who needs income, that's a little tough if you needed bonds. Good for mortgages. If you went and refinance, rates are so attractive. And now is if you can handle it, a good time to take on a little more debt. Real estate, generally good for real estate, but bad for CD holders, people with cash, money markets, bad for banks and insurance companies because of those low rates. Treasury bonds, just don't look appealing at these current rates, but there is cash on the sidelines. Again, if interest rates start ticking up, they could lose some value. And if you look at the yield on the S&P 500, it's roughly 2% versus a 10-year treasury at about 0.6. So not very attractive there. The fourth industrial revolution.
Morgan, we've got a question from Grayson Benson.
Okay.
I think it's about interest rates. So he's talking about interest rates continue to go down. When do you predict they will go back up? What will this mean for bonds, and how will this affect people?
Well, interest rates probably are not going to start ticking up anytime soon. The Fed, at least the short end of the curve, has decided to keep rates low for at least through 2021. So we don't anticipate a change there. Rates will be forced up on the longer end part of the curve if we start seeing inflation. We haven't seen it yet. We track the velocity of money, and it really hasn't turned yet. So we don't anticipate interest rates going up for some time. But if it does, and when it does, maybe sometime after 2021, it'll start impacting those who own bonds. So again, your longer dated bonds, anywhere, say 10 years out, 7 years out, maybe, you're going to start losing some value as interest rates move up. Good question, though. Fourth industrial revolution, maybe there's an innovation premium. Not sure, but you look at tech, that could continue to look attractive, and many are starting to get in rarefied air. Obviously, they're very expensive. However, you look at quite a few technology companies, and their revenue growth is pretty impressive. Biotech, some of them don't have the revenue growth, but the things they're doing, they'll continue to look attractive. Recessionary stocks, they should generally hold up. So defensive sectors like consumer staples, healthcare. I certainly don't want to sound rosy in stocks because, I would say it's not time to back up the truck and load up in stocks. It's also time to look at some of your winners. You probably made some good money in some of your stocks. If it's over 5% of your total portfolio, probably time to start trimming it a bit. But it's also good to start reviewing your risk. If you took on additional risk to ride up some of this, maybe it's time to review that. Review those winners. Review your allocation. If you're in cash, maybe it's time to start trickling in. Maybe you start adding a little bit. We call it dollar cost averaging. Start putting a little bit in there. But staying diversified. You got to be careful not chasing things. You have to be careful staying in winners too long. Although small cap had a very good second quarter, it also tends to be an area that leads out of recession. And I would say most people are probably not invested in that smaller company area. Talk with an advisor, and obviously we're talking about financial advisors, but if you want to talk to a religious advisor, it doesn't matter. To talk to an advisor, because you need to get a plan. There is probably a pretty bumpy ride coming. There's a lot of things that are coming down, but I think it's happened before. We've seen things, bumpy things in the economy. The economy and the market actually holds up quite well. But those who have a plan, those who've sat down with an advisor, they generally more focused on the long term. Finally, there's one constant in life, and obviously that's change. Shakespeare, he used the shutdown of the theaters in 1590 to write poetry. There's an outbreak in 1665. That's when Sir Isaac Newton used the opportunity to sit near an apple tree and unlock the laws of physics. So change will occur, but fear and panic are not an investment philosophy. This pandemic will end. Things will normalize. The market and the economy, for that matter, will actually move before you get that official green light. Thank you. I'm going to turn it back over to Joe for any questions.
Terrific job, Morgan. Thank you for all your help and a great presentation. Before we get into some more questions, oftentimes as an advisor, a financial advisor, not a religious advisor, but I do appreciate that as a recommendation for all of our clients. Where do you see when someone comes to us with cash or fixed income positions or more of a conservative approach to this market? You talked about it briefly, but you want to get a little bit more into what a game plan could possibly be for a client or somebody who's nervous about the markets right now and think it maybe came back too fast?
Yeah, someone that's that's a great question, because there's a lot of people sitting with cash and it's just sitting there, and it's almost like Murphy's Law. You're like, okay, I'm going to get back in, and then that market just drops. It probably, that's what's going to happen. It drops when you're ready to get in. What we do with those clients is we just slowly add. We put a plan together where we're taking the thought out of it. In other words, it's the 15th of every month, we're going to put something in, and maybe over a year before we get all the cash committed. Unless you had some kind of a market where there's a pullback. If there's a pullback, 10%, 5%, any one of our advisors is probably going to give you a call and say, hey, we're going to go a little bit more in. But yeah, I would take time to add back in, because there's some good companies, and you don't want to miss out on some upside that you're going to have at some point here by sitting on cash. Like I said at the end, the market won't give you a green light when it's time to get back in.
So inch your way back into the market given what's going to be happening in the current environment. So
absolutely.
with that being said, you want to talk about some of the moves Spinnaker made recently that you talked about in your newsletter, going to more focus on some biotech sectors and maybe from value to growth or whatever the case may be?
Yeah, I mean, we're not completely out of value, but we had some dividend payers there for a while that what happened was they ended up being like a proxy. Every time any company that was cutting their dividend, like say a Wells Fargo, all of a sudden those companies would go down. So we did a while back added a bit to growth, and we did add some to our biotech. Just starting to add in those areas. And again, it's back to that, the fourth industrial revolution. We just see a lot coming out of that. We think that some of these, some are getting expensive, but we think that there are certainly opportunities in those areas. We think people should own those. And we like using an exchange traded fund when you look at biotech, because like today, Moderna was down. Moderna was up last week. You look at some of these tech companies, oh man, it's tough to go out and say, buy a bunch of Amazon, but it's certainly when you buy a growth, say a growth ETF that has tech and some other growth companies, or a biotech fund, you're getting a piece of it, but you're not trying to pick the winners and losers.
Great, good. You talked about commodities briefly. Marty's got a question about, should we buy gold? Should we own gold? I know you talked about that a little bit, but if you want to dig a little bit deeper into what it means to own gold, do we own physical gold? Do we own gold in funds?
Yeah, we're generally not holders of gold. As far as using ETFs, I think that some of the exchange traded funds, I think that because they can continue to sell, they can keep selling shares of those things. And I think at one point there were more shares outstanding, more money in gold ETFs than there were in actual gold. I don't know if that's correct, but I had read that a while back. But I think if someone's concerned about the currency or things, unrest or things like that, it doesn't hurt to own some gold, physical gold, if they want to put it in a safe or something like that. We generally don't like it as an exchange traded fund. It is easy to trade back and forth, whereas physical gold and gold coins is not as easy to trade. But if they feel comfortable, we're not against owning some physical gold.
Okay, terrific. Nate Aries out from Arizona asked, can you speak to the rumored Great Depression coming in 2030?
Yeah. Well, 2030 is pretty far out there. I don't know. I mean, I think that we're certainly putting on a lot of debt. That is a concern. But if you want to put on your financial analyst cap, you can sit there and look at from today until 2030, what's our present value of all the taxes we'll collect. Let's look at all the buildings we own. We're probably not underwater yet as a country, but who knows? I don't know. That's pretty far out. We're looking a little shorter than that, but I certainly hope not.
Okay, well that's good. For those of you that are participating, there's a chat feature. There's a Q&A feature on the bottom, and then there's also a raise your hand feature. So I'm going to go to a question from Paul Puma. We're going to try this. So I'm going to allow him to talk. So I'm going to give Paul the floor. Paul, if you want to unmute yourself, I just did. You should be able to ask a question. You there, Paul?
I'm unmuted. Yeah, I'm unmuted.
Go ahead. You want to ask Morgan a question?
Yeah, Morgan, the debt. I mean, trillions of dollars. Where do you see, if anything, the impact on the investment community? I mean, we're so far upside down on the debt. I just don't know how it keeps going and not impact the investments. What's your thoughts?
Yeah, that's a good question. So the debt is getting large. It is getting huge. It is certainly a concern. Interestingly enough, at some point that debt will create inflation. That inflation actually would be something that would be very welcoming to the Fed, because they'll be paying back the debt with cheaper dollars. But at some point, the debt does what's called crowding out. So because so much is going to debt, it crowds out other areas and it starts hurting the economy. I don't think we're there yet. Let's see how these next stimulus plans go. But at some point in the future, the debt will crowd out and will certainly hurt our stock markets and our economy for sure.
Good. I'm asking this question mostly, Morgan, because I want to see you dance around this, but it has to do with the election. So a couple clients continue to ask about, you spoke briefly about the election, but can you elaborate more on that? As a money manager, as a professional money manager, how does an election year, especially a year like we're in now, really dictate your investment philosophy?
Yeah, I mean, it's funny because you look at 2016 and the polls all showed, Hillary was going to win, and then all of a sudden Trump won, and the futures market, and there were all kinds of things out. The futures market sold off immediately, and things things did not work out well. We don't change. It did not work out well for those that tried to short the market, I should say. We don't really change our philosophy. We're looking at it, we're tracking it. When Obama came in, they looked at, people thought that guns wouldn't do well and green stuff would do well. And green actually did not do well, and gun sales did well. So people that start changing, trying to guess a lot of that, I think that they'll end up losing money. However, like that other slide showed, generally the market's like a split government. So a Biden win with the Senate staying Republican, that's should be fine for the market. I mean, right now the market looks about 6 months out and making decisions. The market's not reacting right now to this, to the election. All the polls show that Trump is down. So I don't know if people aren't believing the polls or the market doesn't believe it, but the market is not worried about it right now. We are watching it. We're paying attention to it, but it doesn't dramatically change where we're going. The changes won't happen immediately if Biden comes in. So right now it's something to watch, but it's not going to dictate our planning currently.
Okay, good. Yeah, Roger Johnson asked a question, what typically happens to the markets in the months leading up to an election? I think you kind of answered that. And then you said, what happens if Trump wins or loses? So I think we covered most of that, but anything to add to that?
No, and it's, people are going to make bets on both sides of it, and we generally, stay down the center of it. I think the Wall Street Journal had one out, talking about how the market was going to fall apart on Trump win, and so it's just you have to be careful, careful what you do. And that being said, I think that everyone should review their risk tolerance right now. If you can't handle a pullback of 20% or something like that, you probably shouldn't be 100% in stocks. And I'm not saying that's coming, but there are quite a few things coming. The debt, the election, COVID. We don't have a vaccine yet. The economy is still pretty stalled. So if you don't have a stomach for some bumps, election or no election, I'd review your risk tolerance and your allocation.
More of a prediction question, but Marie Marston's asking about timing of state and federal tax increases due to all the debt or all the stimulus.
Yeah, I would say a Biden win would change the tax rates. That we'll see some changes there in taxation. So federal taxes could go up. I don't know how soon that happens. Probably not immediately, but we would see that changing. I think all those of us in California too, I don't know, the state's not doing too well too. I don't know where that goes and where those will change. But I think if Trump stays in, taxes stay as they are, and if Biden comes in, federal taxes will go up. Historically he's been a bit more moderate, but I don't see him going back to, these way back before Reagan, 70% and stuff like that, but they'll go up.
Okay, we're going to enter in the lightning round with 10 minutes left, Morgan. So Harry Barton's asking, what are your thoughts on tips? Will a tip rise in value when interest rates start ticking up? And the second part of that, if you bought a treasury, are you locked in at the interest rate when you buy it?
So you are. So a treasury, whatever I buy. So I buy a 30-year treasury today. I give the government $100,000 and they say, thank you. And they say, here you go. Here is your 1.3% per year. That's it. That's all you will receive, all year in, year out. If that 1.3% is a great number and interest rates on a 30-year goes down to 1%, it'll appreciate. If interest rates go up at all, you'll immediately start losing on the value of that bond. So you will still get your 1.3%, but you will, if you needed to sell within the 30 years, you most likely will lose some income there. Inflation tips, inflation protected bonds, basically what they do is they take the low interest rate, but they tack on the inflation rate. So right now, yeah, I mean, they're showing a negative basically. So if inflation goes up, it certainly could help some of those tips.
Okay. Gary Williams, Jr., if you had a client who wanted to invest in rental property, both residential and commercial, as a way to diversify their portfolio, given what we were seeing in REITs, what would be your advice?
Yeah, I think that there's a lot of stuff, especially in California, that is an anti-landlord. I would be somewhat concerned. I think real estate is a wonderful investment to have. And, you know, I think some people that have like VRBOs, it tends to be a pretty good thing because you can get people in and out. You don't have a tenant issue. But I mean, I think where you can find value in real estate makes a lot of sense. I think the commercial real estate is a bit sketchier. You know, I think that depending on what you have, I mean, maybe if you put like a UPS store in there, would be a great, that's a great company to have in there. Someone who can pay their rent, you know it's going to be paid. Or you get a big company that signs a 10-year lease. Then I'd be okay with some commercial. But residential, I think that, you know, tread lightly, but I think it's always a good asset to have because, you know, you have some revenue coming in.
Perfect. Marco Albertini, one of our favorite Italians, no question. He wants to know your thoughts on the euro versus the dollar in the next 12 months.
Yeah, God, that's a great question. I mean, Europe is certainly not doing as well as, you know, or certainly not doing well compared to us right now. So, you know, I think there'll be continued pressure on the euro. Yeah, I think there'll just be continued pressure. I think that they're having some issues, not that we're not, but they're not seeing their economies come back as quickly as us. You look at, say, the southern parts of Europe, you know, France and stuff like that, without any ability for travel, it's going to hurt them. Germany and some of the other areas that can manufacture and they're not as dependent on you know, people traveling and all the travelers and tourism, then I think that they're looking a little bit better. But in general, I think they're going to have a tough go.
Okay. You talk a lot about real estate. This is Brian Liberto. He's wants to know your take on the luxury home market. Why locally are we seeing record prices on new construction?
I mean, I can only, just from people I've talked with, that I think that those that have some money still have money, and they're buying these properties, and especially here. I mean, the Golden Coast here, it's you can't find this land anymore. They're not building. There's not extra land, so it's still a value to folks. And then you have people coming out from New York. I mean, some of these areas that from San Francisco, you know, why do I want to live up there? I'm tired of the city. I have a lot more room here. So I think there'll be continued. I don't know if I want to say value because they're certainly expensive, but there'll be demand in those areas.
And cheap money.
Cheap money.
Yeah, certainly can borrow at a low rate. This is from an anonymous attendee, but a question that we get all the time as advisors. If you could invest a small amount of money today, I mean, this is why we're all on this call, but should I wait for the market to dip before investing? I mean, we've been talking about this since March 23rd.
Yeah, that's right. I mean, and we've had calls with people like that. So I think the answer is no. I mean, if it's a small amount of money, take a even smaller amount and start putting it in. And then start adding to it and just start continuing to add to the market. Back to the green light, the market's not going to tell you when it's a good time to get in. And I think that you risk, I hate to say miss out, but I think you especially if you're looking at a 10-year horizon, you look at the blips in the S&P over that time, and the trend is towards the upside. That doesn't mean it's always going to happen, but generally the trend will be your friend.
I think, like me and all of our clients, I think having your calming voice means all the difference in this market that we're in right now. And I think, to your point, you just have to have a plan. I think markets will go up, markets will go down, but as long as you have a plan and we manage to that plan, the markets are going to do what they're going to do. But over a long period of time, you keep your fees low, you allocate in the right areas, take the emotions out of investing, you're going to win. So Debbie's asking a question about the government seizing 401k accounts based on the debt that we're seeing in the country.
You know, there's been that floating around. I don't know if there's any validity to that. I don't know. I don't see it happening. You know, I just don't see it. There would be such a run on stocks, such a run on, I mean, it would just be, everyone would sell. I mean, if they were coming for mine, I'd be selling in a second, as I would sell every one of our clients. I don't see it happening. I don't know where that, I've seen that floating out there. I just don't see it happening.
Okay. Do you want we'll give you the final word, Morgan, to close, and then I'll turn it over to Andrew.
Yeah, again, I think, as I said in the wrap, it's just, you know, looking at a plan. We're always going to have a lot of things going on in this world, and that's some of it exciting, some of it not so exciting. So sitting down, coming up with a plan, got to be in the market. You know, sometimes being safe, sitting in cash is not necessarily safe. So we thank you all for your time, and thanks for the questions.
Perfect. Thank you, Morgan, for your time. That's great to hear from the Wizard. We'll look forward to doing this again next quarter. Andrew, the floor is yours, Vice President of Spinnaker Investment Group.
Yeah, guys, thanks for joining us during these times. We want to put these events on in an ongoing effort to provide you with that personal CFO service and to continue assisting you with the ABCs of investing. That'd be the asset allocation, behavior, and cost. Those are the aspects we believe that we can control when a lot of it's outside of our control. Also, I want to ask you to join us on social. We've been putting some content on YouTube, so subscribe to our YouTube channel. I know a lot of people were asking about market timing. I just did a video on market timing and also diversification. So go check out our videos on Instagram, follow us there, and on Facebook as well. On our websites, we're going to be posting our blogs and our quarterly newsletters. So trying to get out there in a lot of ways so you guys always feel like you're in touch with us at all times. We look forward to seeing you guys next time. And I'm actually pretty bummed to hear that True Religion is going to be going out of business. I don't know where Joe's going to buy his jeans. So.
That's true. And Chuck E. Cheese, where are you going to go to dinner?
Oh, glad that's over for me.
That's it. All right, guys. Well, thank you to everyone for joining us. We'll see you next quarter.